Good morning. We're going to start nice and promptly. My name is Martin Wolf, the Financial Times. I have had the pleasure of moderating this session on several occasions, and it's always been, is that all right? It's always been very exciting and stimulating and pleasurable, at least for me. And we have a particularly remarkable panel, I think, today to discuss the issue which I'm sure is closest to most of your heart, which is, are we out of the mess? And if we are, what follows? The situation is obviously very, very different from what it seemed to be a year ago, and very, very much better. And we want to address not only the short-term questions of what might happen as we come out of the recession, but also we now have, I think, the opportunity to discuss some of the longer-term structural questions in the world economy, and we will address those as well. Now, before I introduce the panel and the issues, I have been to tell you, first of all, this session will go on till midday, so we have longer than normal. That should give us time for questions from the floor, at least the last 20 minutes or so. So prepare your brilliant questions. After this is over, there will be, you're asked to stay because we're going to have the spectacle of the South African launch, and you all know what that is of, what they are launching. And I imagine that's going to be quite an exciting event. Now let me introduce the panelists. In starting the far left is Josef Ackermann, who's of course chairman of the management board of Deutsche Bank and a very distinguished representative of the financial services industry. And one has to add, a survivor, which is quite something. After the last 2 or 3 years, I admire anyone who's heading an institution that still stands. Next to him is Larry Summers, former Treasury Secretary and so forth, now Director of the National Economic Council at the Office of in the White House, and of course President Obama's principal economic advisor. Next to Larry is Christine Lagarde, who is Minister of the Economy, Industry and Employment in France. Next to her is Dominique Strauss-Kahn, fellow citizen of France, Managing Director of the International Monetary Fund. Next to him is Zhu Min, who has moved from the Bank of China and is now Deputy Governor of the People's Bank of China, the institution that manages approximately $2.5 trillion. So very important person in the institution. And next to him is Montek Ahluwalia, Deputy Chairman of the Planning Commission of India. And as I think I've remarked before in this place, in addition to that, my very first boss. We worked together 40 years ago. I can't hesitate to admit this, at the World Bank. And finally, immediately to my left is Minister Yoshito Sengoku, who's Minister for National Policy in the Cabinet Office of Japan. What are the issues? Well, as far as the recovery is concerned, the short term, a friend of mine, you may be here, Moises Naim of Foreign Policy, said that the fancy acronym for this recovery, which he was giving me, which I mentioned in a blog, is LOVE, L-U-V. L is for the shape of the recovery of the European Union, U is for the shape of the recovery of the United States, and V is for the shape of the recovery of Asian emerging countries. And I rather like this acronym. It seems to me get it very well. Now, in that very mixed picture, in terms of dynamism and overheating, that obviously creates big questions about how stimulus should be withdrawn and where, in what way, and how differentiated it should be. That's obviously a very big question. And that in turn depends very much on whether we should see the recovery we're now having as being a genuinely private sector. We're beginning to see genuine private sector-led recovery, or are we still relying on this simply staggering policy stimulus. I would like to remind you that the monetary and fiscal policy settings in the developed world today have simply no historical precedent. We've never seen anything like this in peacetime. So that creates a huge issue in terms of how we're going to get out of it, where the tightening should occur. Then in the longer term issues we face, we all know some of the issues, global imbalances and exchange rate policies, an issue which is being looked at under the at the behest of the G20, the new institutional format for global discussion of the so-called multilateral assessment program. We have the huge outstanding issues of financial sector reform, which got quite a jolt last week, as everybody knows, with the announcement by the president of the Volcker rule, which shocked, astonished, amazed, and excited and thrilled, I have to say, people around the world. And we have, of course, on a bigger level too, quite fundamental transformations in the relative success and size of nations, economies, the extraordinary rise, continued rise of China and India, and clearly the discredit into which, and we must be clear about, into which the Western models have fallen, and that raises the question of what the new normal, as Mohammed El-Erian of PIMCO calls it, is going to look like. So that's the background, and with that introduction, let me turn first of all to his view on the short term to Dominique Strauss-Kahn.
Thank you, Martin. I think in a nutshell, the news are better. We all know this. Growth is coming back sooner and faster than expected. But we have all to keep in mind that this recovery is still fragile. And it's mostly fragile because when you look in details in the figures, it appears clearly that even if the growth figures are rather good, and the last figure we have from the US are really encouraging, a large part of this is still supported by public funding, and the private demand is still rather weak. So the question of when Martin asked, when should we exit from the stimulus which has been put in place? Let me remind, by the way, that the idea of the stimulus first appeared on this stage 2 years ago under your leadership.
By you.
Thank you. But okay, now we need to exit.
So is it time to end it?
And the problem is, there's two problems. The first one is that obviously the recovery is a multi-speed recovery. I like your LOVE acronym, and it shows clearly that the Asian part of the world is now close to the total recovery, goes fast. It's not exactly the same thing in other parts of the world, including Europe. And so the question of dealing with this different speed in the recovery, especially in the relationship between US and China, is something at which we have to look with great attention. We are not in a system where the recovery looks as if it was everywhere the same thing. It's going to be sluggish, at least in Europe, maybe in the United States, and so that's one of the big problems for the looking forward. If we consider the exit, the question is not only the multi-speed, but the fact that the situation is totally asymmetrical. If we exit too late, even if different countries exit at different time, of course, if they exit too late, it's a waste of resources. It's bad policy. It's increasing public debt. We shouldn't avoid this. We should avoid this. But if you exit too early, then the risks are much bigger. And even if our forecast in the IMF is not at all a forecast of a double dip, the only reason why this kind of tail risk of a double dip may appear would be that the exiting of the stimulus will be go too fast and will be too early. And in this case, frankly, I don't know what we could do, because most of all the thing we had in the toolkit has been used on the monetary side, on the fiscal side. And so the probability is low, but the risk is high if something like this happens. So it's totally asymmetrical, and because the fiscal sustainability problem is going to be one of the biggest problems, maybe the biggest problem in the coming years, but it's going also to be a problem for several years. The question is not of 3 months earlier or 3 months later. We'll have to deal with this for 5, 6, 7 years, depending on the country. So really, the asymmetry between exiting too early or exiting too late is very strong, and our recommendation, of course, is not to exit too early, which means practically that all what has been prepared for 2010 in terms of stimulus has to be really implemented. Now, a second point I would like to make very quickly is that besides the stimulus, one of the big things which has been discussed during the crisis was financial sector reform. And finally, we come to grips with this financial sector reform. A lot of very bold proposal has been made. You just mentioned Obama's proposal. Some other thing has been proposed in UK. And I only have to applaud to the fact that the momentum, the political momentum to deal with the financial sector is still there. My fear is that we may, at this occasion, forget one of the key lessons of the crisis, which is coordination. And the financial sector reform has also to be coordinated. There is big risk of things which will be done only country per country, trying to fix the problem of your own country, limiting the risk for your own taxpayer, and creating problems in other countries. It's obvious that if you just look for a kind of self-insurance where you deal with the liquidity of your own financial sector and ask it to be at the high level of liquidity, you may create problem in the rest of the world. So the question of coordinating this financial sector reform is, for me, a top priority, and I'm a bit afraid that we're not going exactly in this direction. So, two key messages. First, situation is better, but fragile. Let's look a lot on what's going on in the relationship between the traditional Western world and Asia, and especially China. Second message, we have to go ahead strongly in the financial sector reform, much more rapidly than has been done until now, and the political pressure cannot wait for supervisory conclaves and the traditional time it takes to make this kind of reform, but we have to do it in a very coordinated way. And the IMF, as it has been asked by the G20, will provide in April a report on this question of a contribution of the financial sector to its resolution fund or something like this. And I think that this proposal may be helpful to try to coordinate the different ideas which have been proposed until now.
Thank you very much. We'll come to the financial sector reform issue, which for sure later on. I'd like to turn to you, Minister Lagarde, and I would be particularly interested in how far you agree that the big danger, as Mr. Strauss-Kahn has said, is that we withdraw our stimulus too soon.
Martin, I agree with that principle, and although it's not new, but I think that particularly now, timing is absolutely critical. And I'll try to give you three examples. We used to operate under the principle of the triple T last year. It had to be temporary, targeted, and timely. I operate myself now under the triple R principle, where we have to pursue the recovery, and we have to empty the stimulus package bag that we have, and we're certainly going to do so. We have to keep up with the reform program that we had so that the economy becomes flexible enough to pick up the wind as it comes. And third R, we have to restore public finances. And the timing of that and the balancing between the recovery process that has to continue, the reform that needs to be maintained, and the restoration or the restoring of public finances is a tough line to draw. Second example of where timing, I think, is critical, and it has to do with the economy and the point that Dominique just made. It's how do we combine the public opinion frustration and the necessary time that it will take for the banking industry to restore some of its parameters and to rehabilitate itself with those public opinions. Big timing issue. Third timing issue, what you described and what we're going to hear from other speakers is that we have this LUV. I think the shape of the L is a bit different from the capital L as we see it. But clearly Europe is going to grow slower in terms of accounted growth relative to emerging markets. And we see a clear, it's like tectonic plaque which are readjusting, and we are seeing a readjustment at the moment. The question is, how do we regulate, combine, take enough leadership to control the overheating that is likely to take place either on the economic front or on the social political front, depending on whether you are in a rapid growth country or a slow growth one. Again, timing issue.
I would certainly want to come back to talk a little bit more about what's happening in the Eurozone, but I think there's a very interesting discussion of whether we're talking about an uppercase or lowercase L. But either way, the down leg has been rather horrible for many countries, though in fact, I think least of all for France, of the big countries in Europe, including here, of course, the UK. So I congratulate you on the resilience of your country in this crisis. I'm now going to turn to Montek Ahluwalia for a view of what must feel very different. No down leg at all, just a question of the size of the up leg. In India, you did have a slowdown in growth. Is this all over? And how do you see the prospects for India and Indian policy over the next year or so?
Thanks, Martin. Well, I mean, certainly no down leg in terms of GDP, as you say. I mean, after 4 years of growing at 9%, the next 2 years we average about 7%.
Right.
Domestically, of course, you know, when you get used to 9% and all that it holds out, even the deceleration is a matter of concern. But there's no doubt that the economy, like in many other economies in Asia, has weathered this crisis very well. We assume now that, assuming we get back to some kind of global normal, even if it's not the new normal, won't be the old normal, we would hope that in the coming year, I mean, our financial year begins in April, we would move from what looks like 7.5% or so this year to something over 8% next year, and then get back to 9%. Now, there's a lot of questioning, obviously, that if the global new normal is not going to provide the export-led demand to support this, why do we assume that we can get back to 9%? You know, and our answer to that is it's going to be domestic investment-led, domestic investment replacing what would otherwise have been export demand. And that investment should be in infrastructure. I mean, that's the biggest thing lacking in India. So we're really working on whether we have enough projects ready, whether we have the domestic financing mechanisms to support it. And obviously, there will have to be some external financing also. I mean, we're going to move from what was a kind of a near-balanced current account to a somewhat larger deficit. But I don't think the deficit would be more than 2.5% of GDP. And I think with the expected revival in capital flows, that can be easily financed. I mean, the big question facing us, as elsewhere, is the whole issue of exit. Now, like everybody else, we also resorted to a stimulus. I mean, if you measure the stimulus as how much did the fiscal deficit go up, the combined deficit of the central and the state governments, it was about 3 percentage points higher in each of the 2 years of the slowdown. Now, we are greatly helped, of course, by the fact that earlier, the high Indian deficits used to be compared with the Maastricht criterion, and we didn't look very good. Right now, I mean, since the whole point about comparing deficits is to look at what's happening elsewhere, we're reassured that the Indian deficit is lower than the United States, lower than the United Kingdom. Growth is much higher. The debt ratio is not that much different. So really, all the fears that might have existed about the macroeconomics shouldn't exist today. But the signal we're clearly giving is we need to get back in a medium term to a more reasonable fiscal deficit position. It's not our view that the present fiscal deficit, which will probably be about 10% of GDP, taking both the center and the states together, it's not our view that this is the normal thing. But we want to bring it down gradually, and that's what policy will be aimed at. Meanwhile, we hope that we can see a continuing rebound in investment. Now, the good news, I think, is that the successful performance of the economy in the short run has, in fact, created a lot of confidence in the private sector. In fact, there's a marked difference in mood in Asia and the mood, let's say, in the industrialized world. Maybe we ought to be more worried about things, but the fact is that investors are really quite upbeat. And I think on the supply side, I mean, these are economies which have demonstrated a capacity to grow. So on the supply side is not a problem. We just need to make sure that the global rebalancing of demand works to our advantage. And that's what we're trying to do.
Thank you very much. And I think it's a very, very important point to stress that solvency relates not only to the deficit, but also course, the growth of the denominator, nominal GDP, in a country which is growing nominal GDP at way over 10% a year, this is rather easier than one where it's actually shrinking. And it's obviously a central point. And I can also imagine some pleasure in pointing out the number of developed countries with much bigger fiscal deficits than yours after all the lecturing that you have received. I'm now going to turn, we're talking now about Asia, to Asia's giant developed country, Japan. So which was very hard hit by the crisis initially, though there's been some bounce back, but it was a huge decline in GDP because of the external shock. So we're now going to turn to Minister Sengoku for his view of the prospects for Japan. And I think he will be talking in Japanese, so I at least need headphones.
Thank you, Mr. Chairman. It is my great pleasure to be able to be with you at this annual meeting of the World Economic Forum. I'm very grateful to you. In terms of the short-term outlook as well as long-term issues, probably there will be a latter part of this discussion which will take this point up. In terms of short-term issue, now, in the process of correcting the excessive consumption in the U.S., so it will take some time, in our view. However, the so-called Lehman shock of the year before last caused a major fall in our economy, and from that fall, Japan and other countries in Asia, in case of Japan mainly, led by the growth of the Asian economies and China, and also our stimulus package of fiscal and financial stimulus, we are now on the track of gradual recovery. However, in case of Japan, when we look at manufacturing industries, the rate of operation is still 80%. Recovery is still at that level. Therefore, we have a latent internal unemployment held by various business corporations. In other words, many companies try to maintain the employment without laying off the workers. Therefore, we have yet to be on the autonomous, full-fledged recovery. So that's how we see the state of the economy now. But on the 19th of September last year, we have achieved the change of government. That is the first major change over the government in the history of the Japanese politics, and the Prime Minister Hatoyama of the Democratic Party of Japan became the Prime Minister. This is the remarkable scene in our history. We have 120 years of parliamentary democracy, and the 65 years have passed since the end of the World War II, and the 85 years with the establishment of democratic parliament. And we have seen the substantive full-fledged change over the government at this point in time. Now, when we look at the issue of economic structure, well, when we look at the post-Lehman shock years where we had suffered a major blow, not only the world economy, and the Japanese economy also suffered, not only short-term, but would have to go through the major change in medium to long term. We have to achieve a structural change. So at this point in time, in terms of economic structure, the political changeover took place. In other words, we tend to overly rely on the external demand, but we have to change the economic structure of Japan, more dependent on domestic demand and dependent more on the knowledge-intensive services industry led by technology. So maybe the Lehman shock may be the case that we give us the opportunity to change the economic structure, and it has a historic significance that we now are faced with this mission of changing the Japanese economy. I'd like to conclude this at this point here.
Thank you very much, Minister Sengoku. Yes, we'll certainly discuss what some of those structural changes might mean, particularly if we're moving towards more domestic demand-led economies. Everybody always promises this, and yet, as I pointed out in a recent column, by my rough and ready calculations, at least 70 to 80% of world GDP is in countries that seem to be hoping for export-led growth. It would be helpful if we diminished that proportion somewhat, since Mars probably isn't a very good import market. Now let me turn to the new Asian giant, China, which has had an astonishingly successful stimulus program and a remarkable growth performance last year, which some of us, and I have to admit I among them, was somewhat skeptical about, so congratulations. And we hear a lot about the overheating, bubbles, and obviously the government is now withdrawing, thinking or trying to rebalance the economy in terms of excess demand. So what does 2010 hold for China and its relationships with the world? Zhumin.
Thank you, Martin. As you say, China had a good year, and we have GDP growth rate 8.7%. But behind the number, I would say the structure is much more balanced. Consumption growth is very strong, 15.6%. And if you're looking for the regions, and the East Coast have a rather lower growth rate, around 7%, but the Middle and the West have a 12 to 14% growth rate. So within China, the regional imbalancing has been improved. And the rural area has been improved too. Infrastructure improved, and healthcare, highways, education centers has been built because they're part of its 4 trillion RMB stimulus packages. And also, social safety net has been started building up. I think those are the things behind the numbers that looks good. However, if you're looking for this year, the new challenges emerges. The first challenge, I would say, is still the inflation expectations. I have to say, inflation is not there yet, but expectation emerges. Because last year, China has M2 growth rate is 28.7%, and the loan growth rate is 31.7%. It's very strong. A lot of liquidity is in the market. And the last year, overall, Chinese still have a CPR was negative 0.7%. But in December, the CPR number jumped to 1.9%. In this coming year, if oil prices back to the $90 per barrel, and the food prices still have pressures on upside, and we will further reform the price, for example, waters, powers, etc., a few things. And particularly, a caution indicators M1 growth in the past few months much more stronger than M2. That means the cash flow, the money growth is stronger than the general money base. So that means the money velocity actually increase. So that will spot up this inflation expectations. So we think that will be very important issues for China policies in this coming year. The second issue, still most important thing, is a structure change and also deal with the overcapacities. The structure issues in China is a remaining structure issue for years. Obviously, consumption is still lower, investments are still very strong. Yes, 15.6% consumption growth is very strong, but we have a 33% investment growth. So still not balanced to each other. And we will pay more attention to stimulate domestic consumptions. So with serious policy, for example, income distribution policy in the front, further building social safety nets, healthcare, education, pension systems, and subsidize for a lot of goods, particularly to the rural area, to stimulate domestic consumption. We'll keep doing that and make sure the consumption will grow. And we hope and we're expecting this year in the GDP growth rates, and the consumption contribution to the GDP growth rates will more or less equal to investments contribution to GDP growth rates. There will be first time in China we'll have a more balanced GDP growth, but that's the target. Still a lot of things to do. The overcapacity also is a big issue. Last year, with very strong growth, the heavy industry picked up. We have a 16% industry growth, but the heavy industry growth 22%, light industry growth only 12%. with heavy industry over the growth strong, the capacity increase, for example, for steel mill. China have a steel mill 700 million tons total, but domestic demand is roughly 520 million tons. So it's around 180 to 200 million ton overcapacity on steel mill, which is quite a big issue. The same thing happened on cement, for example, shipyard building, and there are all the few things. We understand the US consumer is gone. Last year we had a negative 16% export drop. We don't think they will come back. So we have to carefully manage the overcapacity issue, which obviously is an important issue for restructuring.
Yes,
The
we'll
second,
sorry.
Yeah.
Go ahead.
The second main challenge for China, still the macro management. We expect to see, I very much agree with Dominique Strauss-Kahn mentions, the rebound strong but still very fragile. We expect to see a weak, very volatile economic growth in the international arena this year. And particularly, we see in the US economy, we have a bumping road, very fragile quarter by quarter, which obviously will have impact on Chinese import because we impact Chinese exports. And so with a consistent macro management policy, we'll continue with current relatively accommodating fiscal and monetary policy and make sure have a smooth macro management and make sure the growth path was stable all the year along, which is also a major challenge. We're shooting for roughly 8 to 9% of GDP growth rates, but we're confident we'll get the number there. But the key issue for China is not number per se. It's rather the quality, the efficiency, the structure. We want to reach more balanced, more consumption-driven growth for this year. With all the policy in hands, we're pretty confident we probably will be there. Hopefully, the international environment is good.
Obviously, one of the many issues you've raised there is if investment is growing at this rate, and there is such an enormous excess capacity in some crucial industries, many people are very concerned that when we look at the picture in 2011, excess capacity will be even greater. And perhaps later we can come to the question of whether the Chinese government has any way of getting a handle on that issue, which I think terrifies the wits out of many people around the world. The numbers you give, if I remember correctly, your excess capacity in steel, it must be roughly the total production of the European Union, and vastly greater than the production of the United States or Japan, which are, after all, not small economies. This is quite a phenomenon. Mr. Ackermann, Josef Ackermann, how does the recovery look to you from your industry? Are you back to lending? Many people say you're merely back to making fortunes for yourselves, but there's no credit growth in any of the significant economies. How far is there genuine healing of the financial sector as it bears on its capacity to support growth, particularly in the developed world, where it's clearly a problem, over the next year or so, before we get to the financial structure issues?
Thank you. Well, I agree with Christine that probably the L is somewhat too pessimistic for Europe, but I also think that the U and the V is somewhat too optimistic for the other regions. And if you look on macro numbers, I think that's somewhat misleading, because as many of you know in the industrial sector, if you look at different segments where the correction has been 30, 40, 50%, even growth rates of 5 or 7% means that you will have years to wait before you reach the pre-crisis level. That's why I think the situation is still pretty fragile. And if you look at the financial markets, they have become pretty nervous again. There are a lot of threats on the horizon. It's asset inflation in some parts of the world. It's clearly the commercial real estate in some parts of the world. It's also what we are seeing in terms of carry trades, which may be unwound. But of course, also sovereign risk has become a major issue. Legacy assets still in the banking system. So all in all, I would say we better keep everything on the somewhat cautious side. The banking sector is clearly benefiting from the tremendous initiatives being taken by governments and by the central banks. But there's also, of course, the risk of the timing and the impact of the exit strategies, which is pretty an unknown to all of us because we have never gone through that. And on top of that, we have a complete change in the geopolitical structure, namely what you just mentioned, Martin, this adjustments to the Chinese growth, to the Chinese capacities, means a lot for the other parts of the world. And I think we have to cope with that. And in the transition phase from a geopolitical situation where you had a superpower dominating to a multipolar world, you will see a lot of uncertainties, and I think you will see a lot of volatility. Now for banks, those who have been more in the sales and trading have been quite successful, also due to the fact that there was a lot of liquidity in the market. Those who are more exposed to the real economy clearly have seen that default rates are going up and that the situation in many parts is still not very satisfactory. And some of the legacy assets are still on the balance sheet of banks. Now, lending, there is, of course, always two sides to the story. If the real economy slows down so much as it has done, the demand for credit is also lower. And that has to be taken into account when talking about statistical numbers. But it is also true that the regulatory uncertainties, the taxation issues which have come up, but also the risk awareness of banks have led to a more cautious credit policy, which has an impact on the credit supply.
Thank you very much. And again, underlining, at least for the developed world, this extreme sense of uncertainty, very much a contrast, of course, with the very different challenges we see facing Indian and Chinese policymakers. Finally, in this round, I'd like to turn to you, Larry. How does the US now look? And particularly in the global context you've seen set out. And one issue that I'm particularly interested in your comments on, the sort of growth rate forecasts we're seeing for the US at the moment and for Europe as well do not suggest any significant tightening in the labor market. There will continue to be a hangover of high unemployment, a very high unemployment in the US, in a way reflecting the extraordinary flexibility of its labor market and the rapid rise in productivity. Does that concern you not only as an economic policy matter, but even as a political matter in terms of maintaining the general thrust of an open, integrated world economy?
Martin, thanks for being here, and more or less, thanks for that question. What we're seeing in the United States, and perhaps in some other places, is a statistical recovery and a human recession. We're gratified by the most recent GDP figure. It suggests that the policies to contain economic collapse have been successful. And my judgment, and I think most people who've looked at its judgment, will be that GDP growth will continue at least at a moderate rate for the next several quarters. What is disturbing is the level of unemployment. And this is not just a cyclical, though it is heavily a cyclical phenomenon, but a structural phenomenon as well. Just to put it in a way it's not usually put, 1 in 5 men in the United States between the ages of 25 and 54 is not working right now. And a reasonable extrapolation would be that following a reasonable recovery, it will still be 1 in 7 or 1 in 8 who are not working. That's in contrast to the mid-1960s, when 95% of men between 25 and 54 were working. That suggests quite profound issues that will ultimately impact politics, that impact the decisions that businesses make, and underscore what President Obama emphasized in his State of the Union address a few days ago, the primacy of jobs. And I might also suggest the primacy of maintaining the flow of credit to medium-sized businesses as a policy objective. I am very optimistic about our support for an integrated global economy. I think for a whole set of reasons, the diversity of its population, the openness of its institutions, the way in which it serves as a magnet for people from all over. I think the United States is very, very well positioned to gain from increased global integration, but it's going to have to work for people if it's going to be politically sustainable. And that's why the jobs, the credit agenda are so very crucial. I might just also say that while I believe very strongly in the importance of growth-oriented policies today, because no one is going to have a healthy fiscal situation in a global economy that's not growing at a reasonable rate. I think it is also essential to recognize, and maybe this is a segue to our medium-term discussion, that in the United States and in other parts of the industrialized world, you know, we're somewhat unique in the United States in doing every 6 months a careful 10-year budget projection. And so our problems become particularly salient. Those aren't done in most other countries, but if they were done in most other industrial countries in the same way our Congressional Budget Office does it, it would not be pretty. And our ability to maintain confidence over the short and medium term will depend not on taking overly rapid fiscal consolidation, which I think could be quite problematic, but in finding ways to provide confidence that over the medium term we are not on trajectories where debt grows indefinitely at rates more rapid than income. And so that too is a crucial part of the American macroeconomic policy picture, and I think needs to be kept in mind as a general issue.
Let me just, before, I would feel remiss if I didn't address this issue now, so which fits actually sort of interface between them, which is how the external environment, what's happening in the external environment, particularly in relating to the so-called imbalances problem, which is also being addressed. And I don't think it's an issue we can avoid, exchange rate policies around the world, including those of China. How relevant you feel those sorts of questions are for the sort of short to medium term prospects of the US, or how much essentially this is all still fully within your own domestic control, that that the external environment is in no sense a constraint on your ability to deliver the sorts of outcomes that you need, not only in terms of GDP, but in terms of obviously generating jobs for these people, I presume many of whom had lost jobs in manufacturing.
Is that for me?
That's for you.
I will leave exchange rates to the Secretary of the Treasury, but I will relate very well to Dominique's comment that not everyone can have export-led growth. And the way we get to that picture, I imagine, Dominique, is the countries that traditionally have had export-led growth desire to continue that export-led growth. And the countries that haven't had export-led growth and have been substantial borrowers desire to reduce their borrowing. And there is an adding up problem, and I think it's quite a serious adding up problem. And we do need some policy reorientation if we are going to maximize two things. If we're going to maximize the adequacy of demand and its location in the global economy to push push growth forward, and if we are going to maintain support for the global open trading system and maintain resistance to protectionism. You know, one of the last points he made in his writings before he died was Paul Samuelson emphasized that strong and robust as it was, the principal some of the most important qualifications to the standard economic arguments for free trade went to situations in which there were significantly unemployed resources and aggregate demand shortfalls, and went to situations in which mercantilist policies were being pursued in some parts of the world. So I think this rebalancing issue is important both, to use IMF-type lingo, in a conjunctural or cyclical context, and in terms of the medium-term growth paradigm.
I'd like then actually to bring this conversation, which now gets to sort of somewhat longer-term issues, to Dominique Strauss-Kahn. And there are two issues particularly which you might want to address. The first is the one that we've just discussed, and you are engaged in this mutual assessment program, which is a very interesting new initiative, which is actually mandated to you by the G20 leaders themselves, and you're supposed to produce some estimates of the compatibility, consistency, the adding up, as it were, of policies around the world, of the big countries by April, and then also where we are on the financial reform question. You raised particularly yourself the question of are we all doing this in a coordinated way? We have a global financial system. Obviously, everybody knows there was tremendous anxiety or distress or whatever it may be expressed about the sudden announcement by President Obama last week. So perhaps you would like to address those questions as well.
Well, thank you, Martin. On the first question, I think that the well-known question of the imbalances are looking a little better than before the crisis. If you really want to make kind of caricature, we had a huge country with huge deficit, namely the US, and the other side, a huge country with huge surpluses, namely China. Now what happens? On one hand, the US consumer is saving more, and I think this is going to last for a rather long time because of important change in the household's behavior. If it's the case, that's good news for the imbalances. Maybe bad news for growth. We'll come to that later. But that's good news for imbalances because, of course, more saving means less deficit, both on the domestic side and on the current account side. On the other hand, in China, the very strong stimulus which has been put in place was basically to shift from a totally export-led growth model to a more domestic growth-led model. And this also goes with a rebalancing of the situation. So on both sides, things are improving. Is it enough? Obviously not. And when you're looking to the new sources of growth, and when you're asking yourself who is going to replace the US consumer if this guy is going to consume less, then everybody's eyes are turning to emerging countries, including China, and hoping that the decrease in US consumption will be offset by an increase in emerging countries' consumption, China, India, Brazil, and others. The problem is that it doesn't add up as easily. It will take a lot of time. It's not the same kind of product. It's very difficult to shift this growth model in China. And so what we have been asked to do by the G20, and the first run will be provided to the finance minister in April, is a kind of just assessment of what's going on. When you take the different forecasts from the different countries and just try to add up, does it make sense, or is there some inconsistency? And obviously, we're not at the end of the process, but we already see that there will be a lot of inconsistency. And then there will be a second stage from April to the meeting of the leaders in June, where some policy can be suggested to correct those inconsistencies. Some simulation can be made to try to see, okay, having these figures which don't add up, what can we do to avoid the distortion and try to have a more cooperative way to look at the future? So I think this exercise, which is totally new, had nothing to do with the different kind of forecast we had before. It may be very useful. But of course, it relies on the cooperation of all the G20 members and their willingness to work together and look at the problems together. I think that the very strong consensus that took place during the crisis, at the climax of the crisis, is still there, and that the willingness to work together is still there. That's the part of hope. We will see how this exercise goes on, but I think that really it's very important for the global economy to be able to see that we went through a global crisis. There's no domestic solution. There can be only global solution, but to be able to assess those global solutions, you need to have a vision of the kind of growth model we may have after the crisis, which obviously will not be the same one before the crisis. Now, on your second point, I just said a few words about this before. A large part of the immediate causes of the crisis relied on the lack of regulation or adequate regulation and supervision in the banking sector in the US and also in many other developed countries. So there have been a big call to try to reform the system, trying to avoid pro-cyclicality and different kind of technical things in which I'm not going to elaborate. And a lot has been done. It would be totally unfair to say that the progress have not been already done. But in my view, it's not enough. It has taken a long time to build things like Basel II, for instance, 12 years. But we don't have 12 years to build the reform of the financial sector today. And so we need to speed up. And the political pressure in most advanced economies is very strong. And so I do understand why President Obama, others may have to propose things. And I think they go in the right direction in maintaining the momentum of this political will to do something. Now, the point is, as I mentioned before, that we cannot have different kind of regulation and different kind of solution in the different part of the world. This will not work together, and even not only it will be inconsistent, but it may also create new kind of problems. So my call is really a call to a more coordinated way to make these reforms. I think all the proposals which have been made are very interesting. I can have some reservation on one point or another, but that's not the real issue. The real issue is that if we want to do something to mitigate the risk of a new financial crisis, I'm not saying avoiding any kind of financial crisis. We will have other financial crises in the future. But if we want to mitigate the risk, then we absolutely need to put in place things which today are not really looked at with enough attention. Let me give you just one example, the one my institution is working with every day. Cross-border banking has obviously been, during this crisis, one of the major issues. And the way a bank from one country is having subsidiary in another country may repatriate what they're doing where they have subsidiary, solving part of their problem at home, but creating new problem elsewhere. This kind of things has to be addressed. And we cannot have a reform of the system which will only deal with the problems seen by each country for its own financial system. And again, it may seem to you a very simple thing, obvious, but in the reality, I'm afraid that we're not following this route, and that's why I call on a much more coordinated way to look at this financial sector reform.
Can I just follow that up? I've got a number of aspects, but with you, Josef Ackermann, from your point of view, are the regulators the problem or the solution?
Well, they're absolutely part of the solution. And I must say that the dialogue between political leaders, regulators, and bankers have become very, very constructive indeed. I think we all know something has to happen quickly to restore confidence in the system. Now, I would, if I may, distinguish between three different layers. The first layer is where we need absolute harmonization on a global level. that is for all these aspects where we compete with each other. That is capital requirements, liquidity requirements. Then you may have a second layer where you may have, for domestic reasons, somewhat different regulations. Mortgage market in Germany or in the United States or you name it. And the third layer, and that is the more complicated one, is where some countries start adding new taxation for whatever reasons or are changing the business model. Now, how you do that on a global level? First of all, what is the impact on efficiency of the global financial system? And secondly, of course, what does that mean in terms of complexity for managing global banks? That's why I'm saying in all these aspects, and I think we are in full agreement that things have to happen, but we need some sort of grandfathering for implementation. But we also have to ask ourselves, what is the trade-off? And the trade-off needs a macro impact study, not only on a corporate level for banks, but also on the economic side. We can stabilize individual banks by having huge capital ratios, but maybe the lending is no longer available, and many other things. Or what does it mean if you have specific regulations for certain activities for the efficiency and liquidity in certain markets? So in that sense, it is much more complex, and I think we should start, and we should start introducing it, and while introducing, we may be able to adapt, because things may go somewhat further than what we have anticipated. Our goal is, and this is the noble task of the financial sector, not only to be resilient to shocks, but also to help the real economy and the people to grow and to prosper. And that is also to always to be borne in mind, because it's an optimization issue between stability and efficiency. And if people think we can move back from a market-based system to a bank-based, that would be an illusion. We are too far advanced in terms of disintermediation of the global economy.
Thank you very much. I'd like to turn now to, do you want to make a comment on this specific issue? Yes, please.
Thank you. In the face of subprime loan issue, the Lehman debacle was triggered and led to the global financial crisis. And what is described as investment turned out to be speculation and very short-term sell-through speculative behaviors, and also the multiple times of leverage. So a sheer speculation. And in the background, there was the state of global excess liquidity so far away from the demand of the real economy. I think it is the view shared by everyone here. So then, this kind of extreme generation bubbles bursting, and then another generation of bubbles and bubbles. Well, after 1990s, in the process of globalization of 20 years, this kind of fallacy has been repeated in the world economy in a way. So some kind of global center of regulation would be needed. Or maybe a case like international solidarity tax to tax the speculative transaction of currencies and others, and that tax revenue could be used for the aid assistance to developing countries or for alleviating the global environmental issues. And whether the government in the world would agree to that and accommodate to that. That, I think, is a major issue. Now, we in Japan, or Asia, shall I say, we have this philosophy of living with nature. And we always look at medium to long-term investment. I think capitalism, in essence, has the ethical backbone and linchpin. So the lesson we should learn is that the capitalism we will nurture would be the capitalism to nurture and grow the economy, not the leverage capitalism of selling through, and to serve the real economy and the requirement. So capitalism should undergo a major change. The entire world should not look at the speculative financial transactions, short-term selling, and the arbitraging. Well, that would cause the entire fatigue of the world economy. Now, in Japan, is committed to continue to excel in our manufacturing technology activities and green and ecological technology like clean energy and the Shinkansen rapid transit and the marine water desalination and so forth. Such advanced technology we are willing to offer to all the countries in the world and to make it as a part of long-term project by all. And this is going to be a part of a national strategy to cooperate with all the countries.
To hear that your language is more or less identical to that of the French president. Two very major industrial countries both think that capitalism needs pretty comprehensive reform. I think that the issue, very important, is probably a little bit beyond the panel, but it's certainly on the table. And then there's another sort of capitalism. We hear constantly about state capitalism and its impact on the world. So that brings me perfectly to you, Jumin. So I'm going to raise a couple of structural issues with you. One we've already talked about. Some of us think that $2.5 trillion in reserves might be enough, and that maybe there are higher return investments. And some of us wonder why you're so determined to let the Federal Reserve make your monetary policy, which, as your own government has frequently pointed out, is wildly inappropriate for China now. So there is an issue about how you manage your external policies in the medium term. Exchange rate, reserve accumulation, monetary policies, how is that going to evolve? It has enormous impact on the world, and that fits very well with China's idea about how this medium-term structural shift towards consumption, towards a better balanced economy is actually going to proceed in the post-crisis era. How do you see these two aspects of your policies fitting together?
Well, basically, Martin, thanks for the question, though. And it's still the growth model, as Larry mentions and as Dominique mentions. This crisis tells us a pure export-driven growth model is not sustainable. And we have to change it. And we're working on it. And I think everybody agree with me. Last year, things have been improved. But it takes time because it's a structure issue. And in the front, there's income distribution issue. In the back, it's social safety net issue. And then a lot of other issues, financial instruments make people be able to borrow money. But the real fact is that China get rich only goes through one generation. In the UK, it takes 150 years from poor to middle income. In the States, it takes another 60 to 80 years, 3 to 4 generations to get people to get rich. So the consumption behavior is very different. I'm still a very old-fashioned person. If his glasses works okay, I will not throw them away to buy a crystal one. Although my income increase, I will still use it. So this is a lot of things behind. And we really want to increase domestic consumption, but still it will take some time. Internationally, U.S. have total private consumption is $10 trillion US dollar. And Chinese added them together less than 2 trillion, 1.65 trillion. Plus India, I think less than 3 trillion. So there's still very unbalanced structures. This is need a lot of international cooperation to manage a balanced, smooth structure change for us to increase the consumptions, and for the other side to decrease consumption, increase saving as well. I think this is the fundamental issue. I think that the whole thing, everybody sees that, and everybody working on that. We saw on the U.S. side, the saving rates increase, and also the current deficits on the upside, and consumption stabilize. And the upside thing happen in China and India, consumption increase. But there need a lot of policy cooperation in the international level because it's absolutely a global issue, and it's a long-term issue. It's not short-term. You cannot do the whole thing and overnight. Now, I'll tell you a good news is that young people in China have a very different consumption patterns. between the age of 20 and 30. They have 200 million to 220 million now. And they are growing. Hopefully, they will buy more, but I don't know whether they can borrow money because they have no money. I think that's the first issue. The second issue is, yes, China accumulated a lot of foreign exchange. Everybody talk about that. And it is a problem, right? How can we have more foreign exchange? You have no more money. People say, you have too much money. How can this become a problem? I think that's the real issue. Sometimes it's difficult to understand. I did a few things. During the Asian financial crisis, all the Asian countries run. You need a self-defense ring. You need enough reserve to protect yourself. Otherwise, you're very vulnerable. We saw what happened in South Korea. We saw what happened in Indonesia, Malaysia, about whatever. And we were lucky to be immune from that because the capital account is closed, the currency is non-convertible. We still have enough reserve. I think it's a very important issue still today because within the globalization, without a very sound global reserve system, and we need those things. Number two, this is a very structural issue. The reason we have more reserve because we have more saving. The reason we have more saving because other side have less saving. So it's just the migration of the global saving dislocated in the different areas. We will be more than happy to have international cooperation on those issues to solve these issues. It also require on international cooperation, and still it's a long-term issue. But I think this is an issue and need to be solved, and China is open and ready to engage in all this process.
I think that's a very impressive answer. I still have this strange feeling that if you sent a check for $1,000 to every man, woman, child in China, they'd find some way to spend it. But maybe that is a mistake, and they would actually all invest it. They could. The United States has
well,
lots
if we send every dollar to every Chinese system, Martin, do you want to be a Chinese?
I don't think I'd make a very good Chinese. Montek, how do you see the structural problems? You have a very different position from in the world from China in this respect. Nicely balanced. And this is just somebody else's problem. And how does it bear on your own strategy?
Yeah, this is what they call a rich discussion, in the sense that a large number of issues have been raised. So I want to simplify a little bit and just make 3 points, which will cover some of the different issues. I mean, the first is we've had a very good discussion on the rebalancing of global demand. I mean, it's very simple. If you want to sustain a particular growth on the supply side, which is feasible, there has to be the demand to sustain it. And we know that industrialized country demand is going to go down, so somebody's demand must go up. Now, as far as India is concerned, we're contributing our bit. We are trying to jack up investment. Zoomin mentioned that China is jacking up consumption, which is excellent. It makes sense from their point of view because consumption is a very small proportion of GDP. In India's case, investment's good, but it's still 36, 37%. We want to raise that. The net result, we hope, will be a current account deficit, not a kind of near balance. So I think in that sense, we are small players in the big G20 group, but whatever it is, we are going to be contributing to global demand. Now, from our point of view, to sustain that, we have to be able to finance the current account deficit. So a lot of the financial reform issues that are being talked about are very relevant for us. We welcome the move in the global financial system to put in place a reasonable regulatory structure. Actually, our banks were always, what now is a great compliment, were boring banks, right? I mean, we weren't out there at the frontiers of innovation. So from our point of view, the global regulation that's being talked about will bring the global norm closer to the more conservative things that we were doing, though we would still have to move in the direction of financial reform and liberalization to get to what the world thinks is appropriate, and we'll do that. Well, what we are concerned about is how is that going to affect flows towards developing countries. Now, in India's case, I mean, it could be argued that bringing in regulatory reform, once the system has settled down, should actually send more flows to developing countries, because we know that what was going on was an artificial creation of a belief that you can be highly liquid and earn high returns in the domestic industrialized country markets. That's no longer going to be the case. So where is it that high returns are going to be earned? Clearly in the fast-growing parts of the world. As and when the financial sector has worked that out, which I hope they will, it should become possible for them to think that in the mediation of savings, it ought to be moving towards at least the faster-growing emerging market countries. We are not going to be very dependent on commercial bank borrowing. So even if there's a temporary constraint because deleveraging, I don't think we are worried about that. Our ability to absorb, to borrow what we want to absorb will not be affected. We're much more concerned about what happens to foreign direct investment flows. And that is not just a matter of what happens in the financial sector, it's a matter of how people perceive globalization. So I'm hoping that we will get the financial reform done. I'm hoping that it is a financial reform that will keep in mind that rational allocation of capital will mean more going to emerging markets and less going to exaggerated mortgages, et cetera, in the industrialized world. But a concern here is whether the regulatory reform will be a disguised form of financial protectionism. Now, that's an issue that, as the reform, structural reform, is played out, and we're glad that that's being done, or should be done, in the Financial Stability Board, which is now being democratized. All the G20 countries are members. We are participating in the process. I think we want to be sure that disguised financial protectionism does not find its way into the system under the guise of improving the regulatory structure. So the third key point, I think, and that's going to affect a lot of investor animal spirits, is what happens to all the protectionist noise. Now, there is genuine concern around the world that there's too much protectionist noise. There's actually also an appreciation that there's much more noise than action. And I think from a political point of view, we know that if you're experiencing a downturn, I think the points that Larry made about the numbers of people who are out of a job, because actually some of them have walked out of the labor force, is much larger than the unemployment rate. Clearly, that's a political reality. The world recognizes that. So I'm hoping that the protectionist noise remains noise and doesn't get translated into action. But one of the issues that we need to think about, for the last 5 or 6 years, in the industrialized world, the charge towards globalization and integration has been led by the financial sector. The manufacturing sector has actually taken it for granted and not been the leading force in pushing for multilateral trade negotiations, et cetera, it's really been the financial sector. Now, that sector at the moment can be, as it were, in cricket terms, retired hurt, nursing its wounds, understandable, it'll come back. But as a result, in the short term, you do not have in the industrialized world an organized voice pointing to the need to maintain an integrated, open global economy. I was very encouraged by what Larry said, that this is a win-win situation. He said that yesterday in this forum. It's a win-win situation, and in the U.S.'s long-term interest, an integrated global economy is very important. I think what's going to happen is that the ability of the world to resist protectionist pressure, which is actually now in the industrialized world, this is one of the great asymmetries. 10 years ago, emerging market countries that were bringing down trade barriers were fighting a lot of resistance and nervousness in their countries. And we've done that successfully and actually created a private sector which is quite open, quite confident, willing to get on with the world. I think it's now going to be, it depends on the quality of political leadership that can be mobilized to make sure that something happens. And this is where the Doha round comes in. The credibility for global action is going to be tested by the Doha round, not by climate change. That's a very important issue, but it's a longer-term issue. I find it very difficult to believe that if the global community can't resolve multilateral trade negotiations, that it will be able to handle much more complex issues like climate change. It's going to be difficult. That's it. Thanks a lot.
I'm losing control. You covered everything. At least you've done my summing up. I'm losing control, as I knew I would. This is ultimate herding cats experience. Dominique Strauss-Kahn wanted to intervene, and I want to offer Minister Lagarde a last word before we might get a couple of questions, if we're very disciplined.
So, thank you, Martin, for giving me the floor for the third time. I'll be very, very short. Looking at the new growth model and what we're going to do in the coming years, there are different points, and I don't want to address all of them. One is obviously debt sustainability, and that will be one of the main concerns for many countries. Another one is the one we're just discussing extensively on the relationship between surplus countries and deficit countries and this kind of thing. But the third one I would like to emphasize on a little is that the growth model obviously will be a low-carbon growth model. And it may surprise some of you that it may be a concern for the IMF, but it is, because when I look at what happened in Copenhagen, it seems to me that the question behind the discussion was not only the question of a binding requirement or thing like that, but also obviously a question of financing. And I cannot believe that the problem could be as big as we all know, saying that it may be the biggest challenge that mankind ever had to face, that for several generations our kids and the kids of our kids will live in an impossible world, and that we will be stopped by traditional financing problems. So then if we have to think out of the box, then if it's obvious that developing countries don't have the money to pay for adaptation and mitigation of the climate change problem, if it's obvious that developed countries don't have the money because they have this debt sustainability problem directly linked to the solution we provide for this crisis, then we have to find innovative way to finance it. And we are going to provide some idea, build around a green fund devoted to finance the 100 billion a year, which is the figure which is commonly accepted that is needed for addressing the problem, based on a capitalization of this fund coming from central banks backed by special drawing rights issued by the fund. And we are going to propose a system which will be criticized a lot, but that's not the problem, which provide a very innovative way to try to find the financing to deal with a question which cannot be seen as a huge problem with no solution. So the growth model out of the crisis is certainly has to deal with traditional question of growth model, debt sustainability, imbalances, and all this kind of thing. I'm not saying that's not important at all. That's of critical importance. But also, it has to do it has to be a low carbon growth model, which means that the financing for this has to be provided. And if it cannot be provided, and obviously it cannot be through traditional and orthodox way of financing, then we have to find out-of-the-box ideas, and we will release a paper in a couple of weeks with one possible of this out-of-the-box ideas based on what we know and what we can do, which is SDR's issuance. So I wanted just to make this small announcement.
Okay. Another big structural issue, Minister Lagarde. I'm particularly interested in two aspects. If you can do them very briefly. Do you have anything you would like to add specifically? Because I know you're very involved in the financial regulation thing. And then finally, there's the Eurozone imbalances issue. Many of us are concerned that the net pressure in the Eurozone is for massive fiscal contraction, and that will make very, very difficult for it to make a contribution to global growth. And after all, the Eurozone is the world's second largest economy. So would you like to comment briefly on those 2 points?
Well, I will actually try to combine the two, Martin, because I think that it's, certainly the Eurozone experience is relevant to the coordination that Dominique was referring to. And coordination of economic policies, just like any coordination, is extremely difficult. And that's what we've been experiencing in the Eurozone. The Eurozone has been in existence for 10 years, the European Union for far longer than that. But to coordinate, to make sure that we adopt the same economic policies, that we see the same urgency at the same degree, the same level, is a tough call. And it's an exercise of discipline that each member has to adhere to. And I have no doubt that all members of the Eurozone understand the issue and understand the urgency of delivering against commitment. It's clearly an everyday test. So when Dominique is referring to the need for coordination, and all of the panel speakers have referred to that need for coordination, I have enthusiasm and concern at the same time. And I believe that in the interest of time, which I believe is very much of the essence, in the face of our public opinions, in the face of the need for development in some countries, of readjustment between others and unemployment rising in many others, I think that in addition to this long-term coordination goal that we should have, which is difficult to accomplish, which is a matter of discipline for each and every member, I would like to commend the IMF and the FSB for the work that they're doing, but my suspicion is that sooner rather than later, they're going to have to enter into a job of reconciliation. In other words, rather than pure coordination and making sure that everybody plays exactly by the same rules, applying the same models, we're probably going to have to enter into this reconciliation exercise where we're going to have to check whether the rules applied here actually are consistent with the rules applied somewhere else and are trying to achieve the same purpose. And I'll give you one example for that. If we look at the accounting rules, for instance, and I won't bore you with the details of former IAS 39, but if we look at the position taken by the FASB and the position taken by the IASB and the goals and purposes and expectations in various corners, I don't see very well how we're going to converge in that respect. And clearly that's where, maybe as an alternative or as a pathway towards convergence and coordination, we're going to need this reconciliation efforts. It's not the perfect solution, but in the interest of time, I don't see what an alternative we have at this point in time.
Thank you very much. We only have 5 minutes, and I'm going to take one question at this stage. See what, very pointed. Does anybody want? Yes. Person who has got a hand up there. I have a suspicion I might know this person. But of course I couldn't see him.
I have to apologise, there's another FT person, it's Chris Giles on the FT. 4 years, almost to the day, the governor of the People's Bank of China sat on exactly this panel and committed China to rebalance demand away from investment and exports towards domestic demand and consumption, and to slow the rate of growth of reserves. I don't know how to put this politely, but clearly we've heard the same thing today, and there might be a little bit of a credibility problem in these commitments. Jimin, could you answer why we should believe you more today than we could believe your boss 4 years ago?
I'm sorry, I cannot see you, obviously, but I cannot hear you clearly.
The question, Jimin, the question was, the promise you made for rebalancing was made here 4 years ago by the governor of the People's Bank. What is different this time?
Well, it's a long process. It's not an overnight thing, right? We're working on those things. It probably will last for another 5 years or another 4 years. And, but we're working on it. You will see the progress day by day, year by year. I can promise you that.
China is a very old country, is the normal answer to these questions. Time is measured differently there. I will take one more question. Gentleman here. I'm sorry, I can't really see the back because of the light. Could you stand up, please? And very sharp. Okay, wait. You need a microphone, otherwise
that's
people
my lucky day.
Everybody's interested in
well,
China.
Well, you are the man, so...
Very quick.
The question is why, I just don't understand why an appreciation of the exchange rate is not part of this rebalancing that you are saying. Even just a few days ago here, you said that you are seeing your currency as stable and stability is a plus. But your currency should not be stable. It should just go up.
Okay. Sorry, Xiumin.
Finally. Exchange rates
1 minute.
is issue.
1 minute.
Oh, I need 1.5 minutes. It's an issue.
We will be shot, or I will be.
I promise I'm under your control. It's an issue, obviously, within this rebalance issue, but it's a small part. Exchange rate change will not be able to change the whole thing. We saw experience in Germany. We thought experience in Japan. You change exchange rates and not necessarily change the global trade balance. I think that's a very important thing. The second thing is China is a developing country and also a big country, and the stability is very important. There are 1.3 trillion people. People need a job. 70% GDP is associated with trade. A stable exchange rate, I think when a crisis comes in, is good for China, also for the world, as I said. And when our neighbor or the other currency depreciate 30%, we didn't do it. When they appreciate another 25%, we didn't do it. It is a part of, in China, it's a stimulus package. We stick with Pittsburgh G20 meeting. The Pittsburgh G20 meeting says the global should coordinate it with access strategy. If the global is ready to do the access strategy, China is ready, and including various things, liquidity issues, exchange issues, and all these issues. It's, again, as Larry mentioned and Dominique mentioned, there's a lot of global coordination is required.
Okay, I'd love to continue with that issue for the next 2 hours. I'm going to make 3 points in 10 seconds, from which I take to be the big takeaways. One, nobody has disagreed that surprisingly, that the great danger is early exit from stimulus rather than late exit, which suggests they're not very confident about the sustained private sector recovery in the developed world. Secondly, there is no consensus on a completely new capitalism, but pretty strong sense that the financial sector shouldn't be allowed to run quite as it did before, but the new proposals need to be coordinated, and there's a lot of regulatory uncertainty out there, and that clearly wasn't really disputed. And finally, this rebalancing discussion is going to be very, very long and very, very messy, but at least countries are saying the right thing because they do seem to realize that Mars isn't a good export market. Thank the panel.
Marty, it could be long, but it could be very constructive.
Of course, it's always constructive. At least the panel is very constructive. I'm pleased to thank the panel. They've been excellent with these huge subjects. And remember South Africa.